Good evening, everyone. John Bowens here. Joining me on today's broadcast is Greg Cohen, CEO of JWB Real Estate Capital. Greg, are you with us?
I am, John. How you doing?
I'm doing very well. Thank you, Greg, for joining us. So for our audience members out there, this is the 3 keys to building a portfolio of 300 cash flowing rental properties. And I'm really excited to have Greg on the call with us today because Greg comes from that discipline area of finding properties, renovating properties, and building a complete vertical system for his company, JWB Real Estate Capital, as well as many of the investors that they work with. So we have an extremely powerful, very exciting presentation in store for our audience this evening. Again, thank you so much, Greg, for being willing to share all of these strategies and techniques that you've learned over the years.
Super excited again to be here with you and to share some of these strategies that we've learned along the way. I'll start a little bit with my story. In speaking to folks around the country, I feel like this is a story that resonates with some. And so we'll talk a little bit about that. We'll get a little bit more into some of the strategies and the 3 keys that I have. And of course, we'll get to those case studies. So about me, my story started right after college. And I remember how excited I was to get this corporate job, as many of us had that vision. And I went and worked in corporate America for a while. And what I remember most about that experience is that I had this idea of how I was going to accomplish my financial goals. And it involved getting up every day, going to work in corporate America, and working there for 30 years and working my way up the corporate ladder. I didn't think at all about what I was doing outside of work. I just assumed if I did that and I took whatever company 401k I earned and I chose one of maybe the 10 choices that I had to invest the money that I would get to where I wanted to go in 10, 15, 20 years. And I remember sitting at my cubicle and thinking, you know, when they asked me where I wanted to invest my 401k, I said, well, how can there only be 10 options, right? How can there be 10 choices? And how do I know that one of these 10 is the right one? And it didn't make sense to me. So I reached out to mentors that I had and eventually landed upon a book that absolutely changed my life, which is Rich Dad, Poor Dad, a book that hopefully everybody who is listening here should read that book if you haven't. But it changed my life. And what I took away from that book was that you had to mind your own business. And what Robert Kiyosaki means by that is it is wonderful to have a job in corporate America if that's your passion or whatever it is, doctor, lawyer, whatever your job is. It's wonderful to have that, but you can't just have blinders on and think that the rest, if you just do that, you're going to get to where you want to go, or if you want to get there, it's going to take a very long time if you do it that way. The better approach is to mind your own business and to think about your investments outside of your job, outside of your career, and to put as much emphasis and training and education and strategy into those. And that's what we're going to be talking about here. So I want to applaud everybody for being on the webinar to do that, to invest in yourself. Now, after I read that book, as John knows, when I find something that I really believe in, I tend to go full steam into it. And you know, at that point, I was about 22 or 23 years old, and my business partner and I went out and bought about 40 rental properties. And that was a lot for a 22 or 23-year-old. And again, I believe so much in what I learned that I was super excited about it. Now, John, that was 2006 and 2007. Remember what happened in real estate in 2006 and 2007, bud?
Yes, I did. Yeah, and particularly in your market, 100%.
There were a lot of 22 or 23-year-olds who went out there and bought 40 rental properties in 2006. Do you know how a lot of them fared after 2007, 2008 as the market crashed?
Yep. But that ultimately opened up opportunity, right? Just about short, maybe 2.5 years later.
Oh, well, it definitely did. And what it did, even more than the opportunity that did open up, which has become our turnkey model, is that it reinforced the beauty of the fundamentals of investing in cash flowing properties. Because those 40 rental properties that I purchased at that time, I still own today. And those 40 rental properties continued to cash flow even as we all know we went through the Great Recession and home prices fell, but my rents were consistent. And that's what I love so much. That's why I'm so passionate about rental properties. It's an alternative to a very volatile stock market investment. right? It's an alternative that provides consistency. And when you work with a solid team and a solid strategy, it can, of course, produce the type of returns that John was sharing through the anecdote early on. So, since then, we built our own company, JWD Real Estate Capital, and the focus is to use that same approach that I used early on to build those 40 rental properties and to bring that to clients who may not live in the right market in order to buy cash flowing rental properties, or they may not have the experience, or they may not have the time, but they want to diversify out of the stock market. And that's our entire focus for our company. So we've been blessed to win some awards along the way and have been recognized as an Inc. 500, 5,000 fastest growing company. It's like 1, 2, 3, 4, 5, 6, 7, 8 times. I'm pretty sure we'll be there for 2019 as well. We've been recognized as the best place to work as well, both by Inc. Magazine and also the Jacksonville Business Journal a number of times. And one of the coolest things that I know we were excited about is when we were featured on the front page of the Wall Street Journal. Through the seminar today, we'll talk a little bit about new construction, but we're a pioneer in the space of new construction and rental properties for passive income. And so the Wall Street Journal featured us on the front page of the Wall Street Journal. We've been featured on the New York Times, Bloomberg. But the coolest story that we have, and I think what really emulates what we're all about at JWB, is our charity events. And our charity event, our biggest charity event to date, happened last year, where we actually built a new construction home and were able to give it away to a wounded warrior, somebody that was struggling with depression and PTSD, and he did not have a home. He was living with his family in different homes. With his parents in different homes. Didn't have a family home for his son. And so we were able to build this new construction home, give it away to him, and I can't tell you what an awesome experience it was, John, to have this wounded warrior shake my hand and tell me that we changed his life, which is our mission here at JWB. So we are, again, super excited to share with you here today. That's a little bit about us. We will take a little segue here into a little bit more specific content on rental properties and why folks out there are looking for an alternative to the stock market. I hear it a lot. There is a lot of volatility out there in the world, and that volatility in the world affects the stock market as it is an emotional place. And so when that happens, it really affects families, right? Folks who have to be on that roller coaster ride are scared. You might hear of friends or family or yourself as you're watching the stock ticker, right? My dad, before he invested with us, would sit there and watch the stock ticker all the time because that's where his money was. And at some point, you become a little bit like a basket case because that's something that you really have very little control, or sometimes fundamentals don't even tell the real story when it comes to the stock market. And that really controls a huge part of your livelihood, right? Because there's not a lot of consistency in it. We know that, over time, the numbers will tell you that if you keep your money in the stock market long enough, you'll wind up with a decent return. I agree. But my problem, though, is that what if that downturn, that volatile downturn happens when you need that money, right? What does that mean for your livelihood? And again, that's why I'm so passionate about rental properties, because rental properties create that consistency. And I think that's what people are craving today. People are craving consistency, right? It doesn't have to be the most incredible return out there. It just has to be something I can count on. I can count on my money being there in 10 years, right? And I can count on this return happening over and over and over again. And I think that gives people great strength and allows people to be more in control. So that's why I hear that people are kind of rushing from the stock market looking for rental properties. But again, the challenge then becomes, I know that I want to invest in a consistent asset class, but I don't know how to do it, right? I'm scared to do it. I've never done it before. I'm scared to be a landlord. I don't know how to take care of things. I'm not in the right market. And of course, that's who we cater to. I think it's really important when you're working with somebody who caters to, to those things as we do. You want to make sure that they run all aspects of the investment like we do, right? Mainly, I'm speaking about property management, so that this truly can be a passive investment for you. And that's what we create for our clients. Let's talk a little bit about Jacksonville specifically, all right? And why consider Jacksonville. Jacksonville is something I will share with everybody. I'm biased. I think Jacksonville is the best market in the country, and I'm not afraid to say it. Now, clearly, I have my own investments here, and clearly our clients purchase properties in Jacksonville, so that's where that bias comes in. But I think there's a lot of fundamentals that that also support that notion, and we'll certainly share those with everyone today. When I compare Jacksonville and why our clients choose to put their money here, it's a different type of investor, a different type of client who wants to look at Jacksonville. And it's somebody, I believe, who looks at more of a balanced approach. When you compare Jacksonville to other cash flow markets out there, I will be the first one to share with everybody that when it comes to highest rent to price ratio, you're not going to find it in Jacksonville. All right. What that means is that you may go to another market in the Midwest, and for the same amount of investment that you make, you may get a slightly higher rent somewhere else. You may get $25 a month more somewhere else. But the client who looks at Jacksonville says, I understand that my rent to price ratio might not be the most out there, but it's pretty darn good in Jacksonville. It is a point where even if you have financing on the property, it's going to cover, the rental income is going to cover your expenses. So it's a strong financial investment. It pays for itself every single month, right? But they also look at it and say, what else out there is a reason for me to invest in rental properties, right? They look at, again, if you're looking at financing, which may or may not be possible for you in your retirement accounts, but if they are looking at that, you get wonderful tax savings, you get principal pay down, right? And Jacksonville is a market that wins when you consider those things, right? But the thing that really matters to Jacksonville's market compared to others is long-term growth and the strength of the economy. The simple fact is that the population is growing in Jacksonville, and it has been for over 20 years. And, when the entire market is going up, when the entire economy is going up, people are moving to Jacksonville in the state of Florida. When you had the Great Recession, people are still moving to Jacksonville, right? People want to be here. And that's just a simple thing to pay attention to, but it really drives home prices and it drives rents over time. And so when you look at what you can do with your investment dollars, the trade that people make who come to Jacksonville, number one, they want to invest with the best team. And I think that is the first and most important thing. But after that, they consider the markets and they say, listen, do I need to make that extra $25 a month by going to another market that might not have Fortune 500 companies, right? Their largest employer might not be something like the Navy, right? Which is a very strong employer, right? Which Jacksonville is. And they say, I'm okay with giving up that $25 a month because that's not going to change my life. But if I invest in a strategy and build up those rental properties similar to the client you were speaking of, John, who now owns 13, and I invest in a growth market and that I know that the economy is strong, and I invest with the best team, then when you compare the total return on their investment over time and you factor in that growth component, that home price appreciation component after 10 years, 15 years of doing this, they're going to wind up with a better overall return. And that's why folks come to Jacksonville. And so if you're thinking about coming to Jacksonville, this is what you should expect for pricing and returns. So you're looking at $160,000 to a $200,000 purchase price. Okay, the median home price in Jacksonville right now is about $230,000. So we are focusing on those middle income to slightly below middle income neighborhoods because that is the cash flow sweet spot for you. $180,000 new construction property will rent for roughly $1,350 to give you some frame of reference there. And your rental income is going to cover your expenses. And it earns an estimated 7 to 9% return on investment. And that 7 to 9% is assuming conventional financing. So if we are thinking of leverage and we're talking about in your retirement accounts, it's still going to be a situation where your rental income does cover your expenses. And so you're in a strong financial footing there. So one thing you'll learn about JWB, and if you may be familiar with us already, this is what the Wall Street Journal spoke about, is that we're a pioneer in new construction rental properties. We started to build new construction rental properties for the purposes of rentals for our clients back in 2011. And it was one day we had been renovating properties for, since 2006 and had renovated over 1,000 rental properties at that time. And we were looking at where home prices were in 2011. And we were looking at what it cost to build homes and the cost of land. And we're like, you know what? I bet that we could build a house and be into that house for the same amount of money if we had to buy an unrenovated property and renovate it for a client. And then we were like, how much better would it be for a client to own a brand new construction home for rental purposes than one that was renovated, right? How much better would it be for the resident if they could now rent a brand new home rather than renting a home that was built maybe in 1950 or 1960, right? John, I don't know if when you were renting properties, but when you were renting properties, did you ever rent a brand new construction home?
Never. That doesn't happen, right?
Right? I know. It never happened. So we stumbled upon this and we found out that we really had something that was resonating with all components of the transaction here, right? A win for clients, a win for our residents, a win for ourselves. And so that's why we have gone so big into new construction rental properties. To put it in perspective, we'll start about 400 new construction rental properties this year, start building new construction, and we'll finish about 300. We should end up somewhere in the range of, the top 5-7 builders in Jacksonville. And that's just, all they do is build. So this is a big deal for us. It's a big part of our value proposition for clients, and it's a big win across the board. And here's how it goes, though. So clients also say, well, I understand the benefits, but why don't more people do this, right? And what I share with them is that the reason that we're able to do such a large volume of new construction today is because of decisions that we made many years ago, right? And so if you're wondering why other folks across the country are struggling with inventory, right? I'm not sure if any of the listeners out here have worked with other turnkey companies out there or have tried to, but many times what you hear is that you get put on a waiting list, right? You get put on a waiting list because they don't have the inventory. And it's not just so simple just to go out and start to buy new construction, to buy lots to build new construction. You had to think of this many years ago. And so when we stumbled across this in 2011, we saw the power of what this could mean for our clients. And we also knew the fundamentals of real estate would dictate that the market would come back. But we knew that if we waited to go ahead and buy land for new construction purposes in 2019 to build houses in 2019, it wouldn't be there, and it wouldn't be there for the right price to make cash flow work. Does that make sense to everybody out there? Right? We had to jump on the opportunity back in 2011, 2012, 2013, 2014, 15, and we had to gobble up as much land as we could. So if you look on this graph here, this is just a range of our acquisitions over time, okay? So if you look at how much our company bought, meaning how many either properties, either houses or land did we buy from 2006 to 2012, came out to right around 500 pieces of land or houses, right? In a 6-7 year period there. Well, then if you look at what we did in 2013 to 2018, right? That number has skyrocketed to over 2,500 properties. And the reason for this is we did not sell 2,500 properties during that time frame. We did this specifically so that we could gobble up as much land at that point for the purposes of having inventory that would be available for new construction to cash flow for clients at this time. And so that's one of the reasons why when you do call JWB, and if it is a good fit and you do want to invest with us, you're not going to hear they have to be on a waiting list, right? We have over 600 lots that we still haven't built on, and we continue to buy enough today to service our clients. So it's a strategy that started many, many years ago, and it's not one that is easily replicated today because land prices and build prices and the cost of labor and materials is much higher today, and the numbers just simply don't work for a lot of folks out there. And you'll see here, this is illustrated in our housing starts as well. So 2011 to 2015, we had just about 150 starts, right? The reason we didn't have more starts then, even though we had a lot of land then, is because we had enough inventory to be able to serve clients that were renovated, right? That we were renovating, or with a smaller amount of new construction. But if you look today, 2016 to 2018, you can see we've had over 500 starts just in that time period. And the reason is because if we only had to rely on renovations to serve our client base today, we wouldn't be able to serve them. Again, this is why many turnkey operators out there are on waiting lists, put clients on waiting lists, because they don't have enough renovation inventory. We now are able to supplement that with our new construction inventory, which has become our focus and, again, has been a big win across the board there. And we talked a little bit about the benefits to owners and tenants. Again, a win across the board. People don't realize this, but we have to think about our residents, and I call them tenants here because that's what people generally know them as. But if you come into JWB's office, they're called residents, right? And it's because we need to think of treating them like gold in order for everybody else to win here, right? So it starts with a resident who wants to put a deposit down on a home very quickly and rent that home out. And John, just like you were talking about, right? If me and you were renting a house back in the day, right, and we had an opportunity to pay basically the same rent and it was brand new construction, we would jump on it, right? Or we have to basically create create a situation where a resident's going to be extremely happy and be loyal and be with us for a long time. Then the owner wins if we do that, and then of course JWB will win by serving those owners so well. Did I miss anything there, John?
No, I think makes sense. I like the idea of having that kind of culture in your office there in Jacksonville, where you're referring to them as residents and not tenants. That makes complete sense. I think that's a critical takeaway for those out there that or maybe even managing their own rental properties. Just starting off and doing a few properties and managing it themselves. Those little things add up and make all the difference. So that was one that I wrote down. That was a key takeaway for me. So I appreciate that.
My pleasure. Well, let's talk about how we serve those residents. And this actually dovetails right into my number one key for how to build over 300 cash flowing properties here as we've done over the years. It's to only sign 2 and 3 year leases. People always say, hey, Greg, I didn't think that was possible. Some people have even said, I heard that was illegal. And I tell them, no, it's not. It certainly is possible. It's certainly not illegal. It just requires a lot of hard work. And the simple fact is that, most property management companies are not built. They're not incentivized to sign long-term leases. And quite frankly, they don't want to do the work required to sign a long-term lease and to find that smaller segment of residents that do want to rent long-term. The reason this is so important is because I believe if you go in signing a 1-year lease on your rental property, you are setting yourself up for failure. And we're going to look at some of the numbers on this. So in our office, sort of an internal rule that we know is that we need to keep our residents in our homes at least 3 years. It's our 3-year rule. And this is broken down based on how much expected maintenance and vacancy costs you will see if your resident stays 3 years versus how much rental income you're going to see if they stay 3 years. And if you compare that to a turnover every year, you're going to see that the 3-year rule applies to where you'll win, meaning you'll hit your return expectations if they stay 3 years. If you have those same expenses and it happens every year or every 2 years, you're going to see by the numbers that you're setting yourself up for failure and just simply not going to hit your cash flow and your return expectations. So this 3-year rule is so important, right? And I want to show you how we get to that number. The question that you should be thinking in your minds as you look at these numbers is, if this is so important, why don't more property managers sign 1-year leases? And again, we'll get into that in just a minute here. But here is an example of a new construction turnkey rental property here. And in the top right section here, you'll see the purchase price of $160,000, 3 beds, 2 baths, 2-car garage, with a monthly rent of $1,150. Now, I believe very strongly in preparing clients for the wonderful things about rental properties, but also for the downsides of rental properties and the pain points. Because as your property manager, I'm going to be there for the pain points when they happen. I can't just pass you off anywhere, right? I need to be there. I need to be accountable. And so the pain points are going to be vacancy and maintenance costs, right? And here, what you'll see in the middle here are your property assumptions of 4% for a vacancy rate and 4% of a maintenance rate. And what that is saying is that's 4% of the monthly rent, okay? And then you annualize that. So your numbers each year, if you actually run the figures there, will come out to about $1,100 of estimated maintenance and vacancy costs. And John, what I'm sharing with everybody, or the person who did buy this property, is this is what you should expect on average. It is going to happen. And the reason that I'm so confident in that is because I manage over 3,000 rental properties and I track returns for every single one of them. And I know what it's going to cost. And so when a client comes on board, I say, listen, it may not happen in the first month. It shouldn't happen in the first month. It may not happen in the first year, right? But over time, each year, your numbers are going to come out to this. All right, it's going to come out to $1,100 that you're going to give back in terms of maintenance and vacancy costs. And if you compare that to what it costs when a resident leaves, that is the comparison here. And that's why this 3-year rule matters so much. So if you look at average turnover costs, you typically have vacancy of 45 days. If you run the principal and interest payments on that, it comes out to about $1,300. If you look at the repairs that you will have incurred, and again, this is me preparing people for the downsides of rental property. Some people come in with, rosy colored glasses, and they think that they're going to be able to turn their property and not have to put money back into it, and it's just not real. The reality is that you're going to need to put money back into your rental property when the resident leaves. It's going to be over and above the security deposit. It's just real. And so if you look at this and you know that you're going to be spending $2,000 when a property turns over, and you've got 45 days of vacancy when that property turns over, which is pretty average, you're going to be incurring about $3,300 of costs. Well, that's where that 3-year rule comes, because $1,100 times 3 gets me to $3,300. John, what would your repair, what would the total cost be if you had 3 years of turnovers, right? 2,000 times 3 years, right?
Yep. Yeah. So you're looking at, well over $6,000. Yeah. Well over 6,000.
Right. And even if you got lucky and you signed them to a 1-year lease and they renewed for another year and they left after 2, you still are going to be below expectations, meaning you're going to be worse off than that 4% of maintenance costs and 4% for vacancy cost expectation, right?
And if you got a mortgage, on the property, if it goes 2 months not rented, those are sunk costs at that point. So yeah, absolutely.
And so, I get a little emotional here. You might hear it in my voice, but I'm flabbergasted that so many people go into rental properties and they do such a great job with their due diligence. They find the right team, they find the right market, and then they go into it with a failing strategy, in my opinion, which is signing 1-year leases. Like, why? Why do that, right? I think you need to be committed to signing long-term leases. And then sometimes people will say, well, what about rent escalations? Well, the reality is that you still can get rent escalations if you have a resident who is signed to a 2- and a 3-year lease, which we do. We do it gingerly, but we do it. But at the end of the day, your returns will be so much better if you forego this $2,000 in repair costs when the property turns for 3 years than you running the risk of a resident leaving after 1 year and then having a $2,000 turn and then having that 45 days of maintenance and then trying to potentially get more rent the next time. Your new rent is never going to cover the loss. In simple terms, keeping short-term leases in order to potentially get more rent the second year and the third year is not a wise decision because it's not going to make up for the loss of the turn cost. Does that make sense?
Makes sense to me.
Love it. So that's where the first key is. You've got to be committed to finding and signing long-term leases, right? 2 years, 3-year leases are only the only type of leases we sign in JWB. And of course, we focus on renewals as well. We renew 70% of our residents. And that's why our long-term tenant stay is actually over 4 years. And in essence, that's a really key metric to ask any partner that you are thinking of investing with. Make sure that your long-term tenant stay number or their long-term tenant stay is over 3. Ours happens to be a little bit over 4. You need that 3-year tenant to make the model work. So the second key, and this gets into, so now if we can all agree that you do need a 3-year tenant to make the model work, the question is, why don't more property management companies sign longer-term leases? And this comes down to incentives and behavior, right? And unfortunately, the property management model is broken, I believe. I believe the goals are not aligned. And I think your most important key when it comes to any type of financial partner that you're working with is that they need to make more money when you make more money, right? Goals need to be aligned there. So my key number 2 here is that your property manager must make more money when your tenant stays longer. Unfortunately, that isn't the case, and we're going to kind of talk through that. Let's look at how a property management company makes money. So John, we have our property management in-house, so I'm an owner of the entire company, right? And so I get to see the books on property management, and I want us all to put on our own owners of a property management company hats on, if we will. And I want you to ask yourself, as we're going through this example, where would you be putting your time and energy, right? And how would it dictate your behavior, okay? So let's look at how a company makes money. A property management company is going to make money with their tenant placement fee, and that typically equals first month's rent. Okay, a tenant placement fee is the fee that the property management company earns day one when they put a new resident in your home. They're also going to make money as a management fee, and that's typically 10% of the rent. Management fee covers everything else about the property management relationship: rent collection, how to handle any maintenance issues, accounting, all that good stuff. And they're going to make about 10% of the rent they collect. So let's go through an example here, and we'll use easy numbers, right? The rent on the property that you are managing is $1,000. So how much do you make, John? How much do you make day one if the rent is $1,000 and you rent the house out? How much do you make in a tenant placement fee?
Well, typically it's going to be the entire $1,000, which is first month's rent, right?
There you go, right? So you make $1,000 day one when you rent the property out. John, I hope you like being on the spot here. John and I have not rehearsed this, by the way, so I'm definitely putting him on the spot. So we've got our rent of $1,000. Now let's look at how much the property management company makes after year one, okay? Well, if it's 10% of the rent, they're going to make $100 a month. And so after a year, they're going to make basically $1,200. So after the first
Greg, question for you and for the audience is, in a traditional sense, would the property management company also be receiving any type of fees for when there's general repairs that are needed? So resident calls, let me be careful, resident calls and says they, maybe there's light bulbs that need to be changed, or washer dryer needs to be fixed, whatever the case may be. What would those fees typically look like?
Oh, you're teeing me up, John. I'm glad you asked that question. You are. I'm so glad you asked that question. The standard out there for property management companies is that when there are maintenance issues that come up, there is typically an additional fee charged, a percentage fee charged by your property management company that you may or may not be aware of. But your total bill becomes whatever the contractor's bill was plus that markup on maintenance costs, and then that's the bill that you see as the owner. It's kind of a dirty little secret in the property management world. JWB, we don't believe in that. Our job here is to hit your return expectations, and the easiest way for us to do that is to keep your maintenance costs low. And so we don't believe that we should do a markup when maintenance costs come in. So if you were talking about any other property management company, there may be some additional fees that they would earn. Unfortunately, that would come directly from you. So that $1,200 number may be slightly higher depending on how much they are gouging you for, maintenance markup, but not JWB.
Good. That's good. Thank you.
Yeah. So let's look at this comparison here. And again, think about what you would do with your time if you were an owner of a property management company. Day one, you made $1,000, for a few weeks of work to rent the home out, versus $1,200 for an entire year of work, right? An entire year of collecting rent, right? Building rapport with the resident, handling any maintenance issues that come up along the way, accounting, just general customer service. I mean, that's a lot of work. We all know that's a lot of work out there. That's why we all want to hire a really good property manager, because we don't want to do it ourselves, right? So if you're looking for the best dollar per hour activity, you are going to gravitate towards tenant placements, right? It's at least going to be a sizable chunk of your business, right? Unfortunately, for us as an owner, it's a bad thing, right? Because tenant placements, mean that we had to replace the tenant, which means that there was downtime, there was repair costs. So us as owners now, not property management company owners, now you're property owners, right? That's not what you want, right? And this is what I mean by a diversion of goals, right? A best dollar per hour activity for the property management company is directly in contrast to the best activity for you to earn your returns. That's a problem, right? Here's another reason that property management companies are not going to sign one-year leases en masse is because a significant amount of their revenue comes from these tenant placement fees. If you actually look at the books, 25 to 50% of revenues for a PM company comes from these tenant placement fees. So in essence, Sean, if you go to, call up 10 property management companies out there and you say, hey, listen, I want to bring a lot of business to you, but I need you to sign 2 and 3 year leases, you're going to get flat out told no by almost every single one of them, I would imagine. And it's because you're asking them to work twice as hard to rent to a smaller segment of the market out there, and you're asking them to make half as much money because they don't get to charge those tenant placement fees to you every single year. A little bit deflating. I hope I didn't, bring everybody down there, but that's the reality. I mean, that is why the model works this way. I just feel strongly that goals have to be aligned. I think, again, you should look at this like any financial partner. And if they're not making money when you're making money, there's a problem. So here are some ideas, right? I think it's really important that over time, you should have lower tenant placement fees and lower lease renewal fees, right? Because of that company's strategy. And there's a number of different ways to do that. So these are things that I think you should look for with your property management partner that you're thinking of working with, right? Maybe that partner has incentives for duration of tenant stay, right? Maybe the property management company makes more money when they keep your residents longer. Maybe you can work that out with some of them. But one that I know is out there, obviously this is how JWV works, is you can work with a reputable turnkey company to have this sort of win-win relationship, right? And I thought I would take a minute just to describe why a turnkey company's their goals actually are aligned with an owner of a property, with an owner of a property. All right, so we talked about how property management companies earn more money dollar per hour when they rent out properties, right? A turnkey company does not operate that way. All right, so JWV, right? Why would we go into this and sign 2 and 3 year leases when, in essence, we are a property management company and we know we can make more tenant placement fees if we just sign 1 year leases, right? In essence, we are foregoing those additional tenant placement fees. And here's why. It's because we know, and history has proven, if we keep your property management fees lower, your tenant placement fees lower over time, that is going to have a dramatic effect on positive returns for you. We're going to beat your return expectations. And we want to bring on clients that have a plan to acquire 5, 10, 20 rental properties. And that's who we work with. And so our bet is that if we do that, we keep your returns at expectations or above, you're going to come back and fulfill your plan with us and buy more houses. So whereas the majority of the revenue for a typical property management company comes from tenant placement fees, it's not that way for a reputable turnkey company like JWV. Right? We make the majority of our money in home sales, and we want to be incentivized in order to produce better returns so you come back and buy to us. So that doesn't have to be the way that you work it, but I am very passionate, as I've mentioned here, work with somebody that makes more money when your resident stays longer, and you'll be much better off. Moving on to number 3, all right, the importance of investing in a growth market and simply holding on. We live in a society now where it's got to be, instant gratification. And if you want instant gratification, rental properties is not the right investment for you. You're going to be disappointed, right? This is about deferred gratification. This is about sticking to a strategy, John, just like you were talking about in your example early on, right? Sticking to a strategy that is time-tested, proven, work with a wonderful team, and then see where it takes you after 10 years. See where it takes you after 15 years, right? The missing component for a lot of folks out there is that they don't pay attention to the growth potential of a market. And I think it's a big miss. So what I'm going to show you here in a second is home values over time, right? Before we spend too much time looking at the details of this chart, we'll get to in a second, I just want you to kind of understand how home price appreciation works over decades now, right? if you look at home price appreciation over the entire country, you'll see that roughly every 10, 15 years, the cycle repeats itself, right? There is a certain home price appreciation. It's a little bit over 3% for the entire country, right? And that cycle tends to repeat itself every 10 or 15 years, okay? And if I get a little bit more micro now, and I'm looking at Jacksonville, I want you to see this phenomenon. This is great for me to see, because when I started to invest, I didn't have, it was 2006. I didn't know what 2019 would look like. But I knew that cycles happen, right? And so what we're looking at on this chart right now is back from 2001 all the way to 2019. And the blue line, you know what, I think that's blue. John, I'm colorblind. Is the blue line the one that's really squiggly?
Yeah, your trend line is the red line.
There we go. Thank you, right? So the blue line are actual median home prices in Jacksonville, and the red line is the trend line. So if you look at historical trends for Jacksonville real estate from 1985 all the way to present day, you'd see a historical appreciation rate of 3.5%. And so that's that line that you see there, that red line, okay? And so when I'm talking about market cycles coming back to normal, coming back to that historical trend, this is what I mean. We know that housing prices shot up in 2006 across the entire country, and definitely in Jacksonville too. That's why you see the blue line way higher than the trend line, right? We know there were a lot of reasons that went into that, lending practices and whatnot, but that was unsustainable. We saw the blue line come way down and taking it all the way down to 2011, 2012, right around where it hit the bottom, right? It was way below the trend line. But as you know, things come back to normal. And if you look at where we are today, we are right almost exactly on that trend line. And this is impactful because in the most volatile home price cycle we probably will see in our lifetime, this idea that things return to the norm after 10 or 15 years has happened here, right? It has happened across the entire country as well. And so things come back. So that's why I believe so much in consistency. And that's why I believe that this is a consistent model, is because if I have this buy and hold mentality, things are going to come back to the norm, right? It's been proven over and over and over again, okay? So if we agree that things are going to come back to the norm and that home price appreciation tends to follow that same cycle as it has for decades now, right? The thing that frustrates me, John, is when folks look at market decisions and they look at it with what I call cash flow blinders on. And I referenced this a little bit earlier. But it's important to take those blinders off. What I mean by those cash flow blinders are that people go into an investment decision. They may compare one market that has, let's call it Jacksonville, with another market out there. And that other market out there may have $25 a month more in cash flow coming in for the same financial outputs, for the same capital investment. But that market, again, may be in a market that does not have strong economics and certainly doesn't have a 3.5% appreciation rate over the long haul, right? And I ask them why they're doing that, and they say, well, it's because it's the highest cash flow for me. And I feel like they're misguided. I feel like 10, 15 years later, they would make a much better decision to invest with all profit centers in mind, right? Cash flow is one of those profit centers, tax savings, right? Principal pay down, and long-term appreciation, and make the best decision in totality, okay? So I put some numbers behind it. This is all from the Federal Housing Finance Agency. And if you look at home price appreciation based on U.S. cities from 1985 to 2018, that's what we're looking at here. And I've chosen some of the more popular cash flow markets out there. We got Memphis, Cleveland, Dallas, Quad Cities, Kansas City, and Houston. And this graph is showing what their actual home price appreciation rates have been. As you might imagine, Jacksonville is at the top of this chart here, right? What I think is really important to know is that it's very normal to have a cash flow market be lower than the normal, the average home price appreciation across the country, right? That is what is sort of expected out there. What is unexpected out there is to have a market where rental income covers your expenses when you buy an investment property and to have it be at the U.S. average or above. You don't find that. You just don't find it other than Jacksonville. So we also need to take into account that the U.S. average is comprised of really highly appreciating markets like California and New York, right? Some of these really expensive places that have much higher appreciation than Jacksonville, but you would never find an investment there that cash flows, right? Where their income covers the expenses. So if you look here and you see that the home price appreciation in Memphis is, 2.5% or right around there, and you look at Jacksonville and the home price appreciation over 30 years now is an entire point higher. What does that mean in terms of real return for you? Well, here's what it means. If you purchased a property for $100,000 in 1985 in Memphis, your property would be worth $224,500 in 2018, which is great. It's a great investment, right? We clearly have seen that home prices have appreciated over time because, again, it follows a model that has been proven over decades here. But what would happen if you purchased that same property for $100,000 in 1985 in Jacksonville? Well, it would be worth $311,600 in 2018. $87,000 in change worth of return that you made for investing in a market that has proven long-term growth potential, right? And it's still positively cash flows. So the reason I get frustrated is because people are only thinking about today. I think they have those cash flow blinders on. And in essence, why people come to Jacksonville is they say, I'm fine with giving up that $25 extra a month in cash flow today. If you're going to put me with a better team, with a better market, and potential long-term growth that is much higher than that $25 a month could get me times 30 years. So that's, I think, a really important notion, and I don't want people to keep those blinders on. And it's not something that gets talked about a lot. So here's my investment criteria. I hope this helps folks out there, but this is what I have subscribed to for the 13 years that I've been building up my own cash flow portfolio here. Number one, I think the most important thing is to invest it with the best team. If you want this to be a passive investment, it comes down to the strength of the team. The team is what converts those fancy looking spreadsheets that you may be analyzing into actual cash in your bank account. And if you want this to be an enjoyable experience where you have a smile on your face talking about your investments, you got to work with the best team. The next thing is you have to invest in a market where your rental income covers your expenses. So even though I just started to talk a little bit about the power of long-term appreciation, I don't want you to go off the rails there. I don't want you to go to the extreme and start investing in a market that has appreciation proven over time, but doesn't meet step one, which is cash flow, right? You need both. You need to have a balanced portfolio. And then number three is invest in that growth market and just simply hold on. Just hold on, right? Don't feel like you have to change it. Find the right strategy, find the right team, and see it through to the end. All right, John, did I miss anything? Anything you wanted to chime in there?
No, I think that makes sense. The three criteria, in terms of looking at investing in a market where rental income covers expenses. I mean, to me, that's a critical one because I know I've seen assets that are cash flowing negatively, and yeah, I can appreciate if someone's looking to invest for appreciation and maybe pay down a mortgage at a more rapid speed, but that's absolutely critical, especially for somebody that's in their retirement years and they're relying on that cash flow. You want to make sure that it's cash flow positive, and when they need that money, they can ultimately cash out. So yeah, great stuff.
Absolutely. I mean, this is coming down to consistency, right? And if you go in with cash flow negative as the plan, if you're consistently cash flow negative, that's stress, right? We don't do that, right? So it's about consistency, it's about preservation of capital, and then putting yourself in a position to enjoy the fruits of investing in a growth market long term. So we've got a couple of case studies that I love, and I love our clients so much, but I think these stories I'm going to share with you are some of the coolest. So I'm going to introduce Liz and Steve to you. You see them here on the pictures here, and the reason why I added this picture of this sailboat on the right is because Steve and Liz have about the coolest story. So Steve and Liz started to invest with us over 6 years ago, and when they came on board, we always ask our clients, why are we investing? What is it for you that you want to accomplish through this investment? And it's got to be meaningful for you. We want to know what's really driving them. And Steve and Liz said, well, here's the deal. we've done well for ourselves over time, but we need a consistent asset that can drive rental income in every single month. And if we can achieve that, then we can sell our primary residence, we can buy the sailboat that we have always wanted, and we can go and sail around the world. And we said, wow, what a cool why. You know, what an awesome why. And so that is the type of relationship that we get to have with Liz and Steve right now. So if you were a JWB client, you would know that we call all of our clients every single month. We have a monthly call to analyze their portfolio with them and talk about, you know, any good, bad, ugly, anything, you know, get to really know our clients much more than just the financials. And it's always really interesting when we have to call Liz and Steve. They have given us the GPS tracker for their boat. And so we always plug in the tracker and try to figure out where in the world they are at that moment. And we see where they are. And then they always have internet, and we're able to talk with them. And they share stories and pictures of different cultures that they are experiencing all over the world. And they check in and they get to see, you know, how their cash flows are doing. And I think it's just a perfect embodiment of what we're trying to do, how we're trying to change people's lives at JWB. So here are how the numbers work. We always track our key performance indicators for our clients. And over time, we've been able to produce about an 8% return for Liz and Steve, a little bit over 6 years of investing. And you'll see here that their net rental income is just under $100,000 in 6 years. That, in essence, is what allowed them to do what they have decided to do. Lifetime total return, again, under $100,000 there. They are investing with their retirement accounts, as we have talked about. And the only difference between net rental income and lifetime total return would be any additional tax savings that you get from the property. You already get them if they're in your retirement accounts, like Liz and Steve. So a perfect example of what you can do with your retirement accounts there. So they invested $195,000 with us in rental properties. And as I mentioned, reporting is really important to us. I think it's a scorecard and a benchmark that people don't typically have when it comes to the rental properties, but we have our what's called our portfolio ROI report. And so when I say consistency, what I mean is if you look 2016, 2017, 2018, 2019, you're going to see roughly the same number, right? Or not a lot of spread, right? You compare that to where their stock market investments would have been at that time, and it would have been up and down, right? And that, in essence, is what we're trying to create, meaning that consistency, that alternative to the volatile stock market. That is what allows them to do what they want to do. We also always prepare clients for an expected annualized return. We share that with them when they make their investment selections with us, and it's that same number they get to see month in and month out, 6.5 years later. And we show up and we say, well, how did we do, right? And in Liz and Steve's case, we've been right there. Just over 7.8%. So Matt and Alicia, super amazing couple, and just married not too long ago. And they came to us, and so we started to map out their plan. This is what we do at the beginning of every client relationship. And this is something we're going to offer to everybody on our webinar here, is to start with a plan, and we'll help build the same type of plan for you depending on your goals. But we sat down with Matt and Alicia and we said, well, why are we doing this, guys? And their why was early retirement and financial freedom. We put some hard numbers to it, and we said, well, what does that really mean? For them, it was $11,000 of passive income each month. We broke that down into a number of properties. It came out to 16 properties they needed. And so then we, of course, have tracked their success along the way. They're at property number 15 of 16. A wonderful accomplishment for these folks, and so happy to be a part of their success. And this year is the year they expect to complete the entire portfolio. Here's how the numbers have worked over time. I might have jumped the gun a little bit because there is a little bit of a delay. There we go. So the numbers over time, there's that 9.8% return. We have 3 years of investing here, and their net rental income over $147,000. Now their lifetime total return is over $224,000, and that takes in the tax savings and principal pay down components. So again, you got to take just the cash flow blinders off, right? That's one component. You got to look at tax savings, principal pay down. The one thing we don't include in any of our case studies and any of our reporting to our clients is their appreciation, because I want you to think of that as a bonus on top. So it's actually not included here. Matt and Alicia brought over $1 million to their JWB portfolio. So $1.1 million in order to buy their investment portfolio and put into those 15 rental properties. And again, if you're going to put that type of money in, and your goal is consistency, you got to have a tracking system to be able to see how you're doing, right? It's amazing how many people go in there, spend $1 million on rental properties, and don't have a way to hold that financial partner accountable. But I know it was really important to Matt as I was talking to him and bring him on as a client. And I think it's so crucial for everybody out there. And that JWB portfolio ROI report is what you see at the bottom here. And again, when I'm preaching consistency, this is what I mean. What I know from personal experience with my own rental properties and from personal experience of managing over 3,000 rental properties for clients is that when you have a portfolio of 5 or 10 or 15 properties, you are going to be okay if something bad happens to one of those properties on an individual basis. As long as you have 2 or 3 or 4 other properties that are performing above expectations at that time, right? And you need to think of this in terms of a total portfolio. And my job and my team's job is to simply make sure that your total portfolio, no matter what craziness happens upstairs, right, up in the properties on an individual basis, we need to make sure that the total portfolio is performing consistently and at expectations. And that's what we've been able to do for Matt. You know, Matt owns 15 properties with us times 3 years. I'll share with you, Matt has had an eviction, right? It does happen. It will happen. But does Matt really care about that when his returns over time, 2016, 2017, 2018, are right around 9-10%? I mean, you can't get much more consistent than that, right? And that is the beauty of what we're trying to create. Again, consistency speaks volumes to our clients. So we told him to expect about a 9% return. He's just under 10%. And, you know, obviously, we're a part of just a wonderful financial future for Matt and Alicia. So if this is interesting to you, if you want to start with a plan similar to Matt and Alicia, or, you know, similar to Liz and Steve, and you want to put that plan together, it starts by talking to our team. You can get your personalized rental investment plan done by our team by going to getyournewplan.com. Again, get your new plan. Go there and let us know this is what you'd like, and we're going to devote some time and resources to building a similar plan for you that will help you. You can also give our office a call at 904-677-6777. But super excited to help each and every one of you develop something that I think can be truly impactful for you and your families.
Awesome. I appreciate it, Greg. Thank you so much. Being said, Greg, any last comments, questions, anything else you can think of before we close down the webinar?
No, I'm just super appreciative of the opportunity to be on the webinar with you, John. It's always been such a great relationship with you, buddy. And I'm just hopeful that we were able to provide a tremendous amount of value for everybody. And, you know, I'm excited to be a part of the team with you guys.
Yeah, absolutely outstanding. Again, Greg, really, really appreciate it. Ton of value as always.